Gerald is 71 years old, retired teacher in Burlington, Vermont, gets $26,000 a year from Social Security, has a small pension that brings his adjusted gross income to about $58,000. Gerald assumed his Social Security was tax-free at the state level. He'd heard Vermont had an exemption, and Vermont does, but only if your AGI is under $50,000 for a single filer. Gerald is $8,000 over the line. He gets a partial exemption, but not the full one. Last April, Gerald owed Vermont $680 in state income tax, entirely on his Social Security benefits. That's money the IRS already taxed at the federal level. Vermont taxed it again. Gerald drove 45 minutes to New Hampshire to visit his sister. She gets the same Social Security amount. She pays zero state tax on it. New Hampshire has no income tax at all. Same benefit, same country, $680 apart, because of a state line. And Gerald isn't alone. Millions of retirees in 8 states are paying state income tax on Social Security benefits that the federal government already taxed once. Most of them have no idea they could reduce or eliminate that bill, and some of them are living in a state that's about to change the rules. This video covers all 8 states that still tax Social Security in 2026, exactly how much you could owe, the income thresholds most people get wrong, the one state that just eliminated the tax completely, and 6 strategies to reduce or wipe out the bill, even if you stay where you are. I'm Joshua with Senior Benefits Decoded. I'm not a CPA, I'm not a financial advisor. I'm a researcher who reads the tax code so you don't have to. Every number in this video comes from official state revenue departments, the IRS, and the Social Security Administration. Links are in the description. If you or someone you love lives in one of these 8 states, subscribe right now, because this information could save you hundreds or thousands of dollars every single year. Let's go. Before we get into the states, you need to understand how the federal government taxes Social Security, because that's the starting point every state uses. The IRS uses something called combined income. Here's the formula. Take your adjusted gross income, add any non-taxable interest from things like municipal bonds, and then add half of your Social Security benefits. That total is your combined income. If you're a single filer and your combined income is under $25,000, you pay zero federal tax on Social Security. Between $25,000 and $34,000, up to 50% of your benefits become taxable. Above $34,000, up to 85% becomes taxable. For married filing jointly, under $32,000, zero tax. Between $32,000 and $44,000, up to 50% taxable. Above $44,000, up to 85% taxable. Here's what trips people up. These thresholds have never been adjusted for inflation since 1993, 32 years ago. Back then, only about 10% of Social Security recipients paid tax on their benefits. Today, because incomes have risen but the thresholds haven't moved, roughly 56% of beneficiaries owe federal tax on their Social Security. And Congress had a chance to fix this in 2025. The One Big Beautiful Bill Act was signed into law on July 4, 2025. It added a $6,000 senior bonus deduction per person for taxpayers 65 and older. That helps. But it did not eliminate taxes on Social Security benefits, despite many people believing it did. There's also a pending bill called the You Earned It, You Keep It Act that would eliminate federal Social Security taxation entirely starting with 2026 tax returns. But as of today, it has not passed. So for right now, the federal tax on Social Security is still in place. And on top of that, 8 states pile their own tax on the same benefits. Let's go through every single one. State number 1, Colorado. Colorado has a flat income tax rate of 4.4%. The good news, if you're 65 or older, Colorado lets you subtract the full amount of your federally taxed Social Security benefits from your state taxable income. That means if you're 65 or older in Colorado, you effectively pay zero state tax on Social Security. But here's the catch that gets people. If you're between 55 and 64, which is a lot of early retirees, the rules are different. You can deduct up to $75,000 as a single filer, or $95,000 married filing jointly. If your AGI exceeds those amounts, the deduction drops to $20,000. So if you're 63 years old in Colorado Springs with an AGI of $80,000, you're not getting the full deduction. You're paying Colorado income tax on a portion of your Social Security. The moment you turn 65, that bill disappears. The mistake, not knowing that the full exemption kicks in at 65. Thousands of Colorado retirees between 60 and 64 are paying state tax on Social Security when they won't owe a dime once they hit 65. If that's you, plan your income around that birthday. State number 2, Connecticut. Connecticut's income tax rates range from 3% to 6.99%. But here's the thing. Most Connecticut retirees don't actually pay state tax on Social Security. If you're a single filer or married filing separately and your AGI is under $75,000, your Social Security is completely exempt. For married filing jointly or head of household, the threshold is $100,000. If you're over those limits, Connecticut still only taxes up to 25% of your Social Security benefits, not the full 85% like the feds. So even in the worst case, 3/4 of your benefits are shielded. The mistake, assuming Connecticut is a terrible state for Social Security taxes without checking the thresholds. A married couple with $78,000 in AGI pays absolutely nothing. A couple with $110,000 pays tax on only 25% of benefits. State number 3, Minnesota. Minnesota is one of the more generous states on this list, but the rules are complicated. If your AGI is under $108,320 married filing jointly, or under $84,490 for single filers, your Social Security is fully exempt from state tax. Above those thresholds, the exemption phases out. It drops by 10% for every $4,000 of AGI over the limit for most filers, or every $2,000 for married filing separately. Minnesota also has an alternative calculation method based on provisional income, similar to the federal combined income formula. You can use whichever method gives you a bigger subtraction. The mistake, not running both calculation methods. Minnesota's tax forms are confusing, and a lot of people just use the standard method. If the alternative method saves you more, you're leaving money on the table. Ask your tax preparer to check both. State number 4, Montana. This is the toughest state on the list for Social Security taxes. Montana's top income tax rate is 5.65% on income over $95,000 for joint filers. And here's the problem. Montana only gives seniors 65 and older a $5,500 subtraction from federal taxable income. That's it. If you're married and both over 65, you get $11,000. But that's a subtraction from all taxable income, not a specific Social Security exemption. Montana essentially follows the federal rules. If your combined income is above $32,000 married or $25,000 single, your Social Security gets taxed at the state level too. There's no special carve-out, no generous threshold, no phase-out. You just get a small deduction. There is a bill in the Montana legislature, House Bill 148, that would eliminate state income tax on Social Security benefits entirely. AARP Montana is backing it, but as of today it is not passed. The mistake, not knowing that Montana offers the least protection of any state on this list. If you're a retiree in Montana with moderate income, You are paying both federal and state tax on your Social Security. Period. State number 5, New Mexico. New Mexico is actually one of the better states on this list, but it wasn't always. As of 2026, single filers with AGI up to $100,000 pay zero state tax on Social Security. For joint filers, the threshold is $150,000. That's among the highest exemptions in the country. Above those thresholds, benefits become taxable at New Mexico's state rates, which range from 1.7% to 5.9%. The mistake: people who moved out of New Mexico years ago because of the old tax rules and don't realize how much the law has changed. If you left New Mexico for Arizona or Nevada specifically to avoid Social Security taxes, and your AGI is under $100,000, you might be paying more in other costs than you'd save by moving back. State number 6, Rhode Island. Rhode Island exempts Social Security from state tax for most retirees, but only if you've reached your full retirement age and meet the income thresholds. For single filers, the AGI limit is $107,000. For joint filers, $133,750. If you're under full retirement age, which is 67 for most people, or your income exceeds those thresholds, Rhode Island taxes your benefits at rates between 3.75% and 5.99%. The mistake: claiming Social Security at 62, before full retirement age, and getting hit with the state tax because the age requirement wasn't met. In Rhode Island, when you claim matters not just for your benefit amount, but also for whether the state taxes it. State number 7, Utah. Utah has a flat 4.5% income tax rate and taxes Social Security to the same extent as the federal government. That sounds bad, but Utah offers a Social Security benefits credit that can offset some or all of the tax. The full credit applies if your modified AGI is under $54,000 for single filers, or under $90,000 for joint filers and head of household. Above those amounts, the credit phases out. It drops by 2.5 cents for every dollar over the threshold. There's also a separate retirement tax credit of $450, but you can't claim both. You pick one or the other. For most retirees, the Social Security benefits credit is worth more. The mistake: not filing for the Social Security benefits credit at all. It's not automatic. You have to calculate it on the Utah return using the state's Social Security credit worksheet. If you use basic tax software and skip the worksheet, you pay the full 4.5%. State number 8, Vermont. Vermont is where Gerald lives, and it's a state that's been slowly improving its treatment of Social Security. As of 2026, if your AGI is under $50,000 as a single filer, or under $65,000 married filing jointly, your Social Security is completely exempt from Vermont income tax. Single filers get a partial exemption up to $60,000 in AGI. Joint filers get a partial exemption up to $75,000. Above those levels, Vermont taxes your benefits at its normal income tax rates, which go up to 8.75%, one of the highest in the country. There's a bill working through the Vermont legislature to phase in a full exemption over 8 years, but it hasn't passed yet. The mistake being just a few $1,000s over the threshold and not taking steps to reduce your AGI. Gerald at $58,000 is only $8,000 over the single filer threshold. If he made a $2,000 qualified charitable distribution from his IRA, shifted some income into a Roth account, and timed a capital loss harvest, he might drop below $50,000 and eliminate his Vermont Social Security tax entirely. And now, the state that just fixed this problem, West Virginia. In 2026, West Virginia became the 42nd state to fully eliminate state income tax on Social Security benefits. The phase-out was gradual. It started in 2022 when the state began exempting benefits for lower-income residents. By 2026, The exemption covers everyone regardless of income. If you're a retiree in West Virginia, your Social Security is now completely free of state tax. Period. No income limit. No age requirement. No worksheet. Done. That means as of today, 42 states plus Washington, D.C. do not tax Social Security benefits at all. Only 7 states still do: Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Colorado technically still has Social Security on the books, but anyone 65 and older is fully exempt, making it effectively a non-issue for most retirees. Now here are 6 strategies to reduce or eliminate your state's Social Security tax, even if you stay in one of these 7 states. Strategy 1. Know your state's exact threshold and manage your AGI to stay under it. This is the single highest value move. If Minnesota exempts you at $108,320 married filing jointly, and your AGI is $112,000, you need to find $4,000 in deductions or income reductions. That could be a qualified charitable distribution, a timing shift on a capital gain, or a Roth conversion in a year you don't have other income spikes. Strategy 2. Use the new senior bonus deduction. The One Big Beautiful Bill Act created a $6,000 deduction per person 65 and older, $12,000 for a married couple, on top of the standard deduction. This reduces your federal AGI, which flows through to your state return. In some cases, this alone drops you below your state's exemption threshold. Strategy 3. Make qualified charitable distributions from your IRA. If you're 70 and a half or older, you can send up to $111,000 per person directly from your IRA to a qualified charity. This counts toward your required minimum distribution but does not show up as taxable income on your return. It lowers your AGI without reducing your spending money, because you were going to give to charity anyway. Strategy 4. Convert traditional IRA funds to a Roth IRA before you claim Social Security. Roth withdrawals don't count toward combined income. If you do conversions in your 60s, before Social Security starts, you build a tax-free income source that won't push your Social Security into taxable territory later. Strategy 5. Time your capital gains. A single large capital gain in 1 year, selling a rental property, cashing out investments, can spike your AGI and push your Social Security into the taxable range. Spread gains across multiple years when possible, or pair gains with capital losses to offset. Strategy 6. Consider whether your state is worth the cost. If you're in Montana paying 5.65% state tax on your Social Security with no meaningful exemption, and you're spending $600 to $2,000 a year in state tax on benefits the federal government already taxed, run the numbers on what it would cost to establish residency in a tax-free state. 42 states don't charge this tax. That doesn't mean you have to move, but you should at least know what the tax is costing you over a 10 or 20-year retirement. Let's come back to Gerald. $26,000 in Social Security, $58,000 AGI, living in Vermont. If Gerald does nothing, he pays roughly $680 per year in Vermont state tax on his Social Security. Over a 20-year retirement, that's $13,600. But if Gerald makes a $2,000 QCD from his IRA to his church, money he was donating anyway, his AGI drops to $56,000. Still over the $50,000 threshold, but now he qualifies for a partial exemption. His Vermont Social Security tax drops to about $240. He just saved $440 in year 1. If Gerald adds the senior bonus deduction, $6,000, his effective AGI for federal purposes drops even further, reducing the amount of Social Security that's federally taxable, which flows through to reduce his Vermont taxable amount. Combined savings, roughly $500 to $600 per year. Over 20 years, $10,000 to $12,000. From 2 moves that took 30 minutes to set up. That's the difference between knowing the rules and not knowing the rules. Here's your checklist. Step 1. Check if your state is on the list. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont. If you're in West Virginia, you're now exempt starting 2026. Step 2. Look up your state's income threshold for Social Security exemption. Compare it to your most recent AGI on your tax return, line 11 of your 1040. Step 3. If you're within $5,000 to $10,000 of the threshold, calculate whether a qualified charitable distribution, Roth conversion timing, or capital gain deferral could bring you under the line. Step 4. Make sure you're claiming the new $6,000 senior bonus deduction if you're 65 or older. It's available for tax years 2025 through 2028. Step 5. If your state has a special credit or worksheet, like Utah's Social Security Benefits Credit or Minnesota's alternative calculation method, make sure your tax preparer is actually running it. Don't assume the software catches everything. Step 6. Calculate your total state Social Security tax over the next 20 years. If it's over $10,000, it's worth a conversation with a tax professional about whether any of these 6 strategies, or a residency change, makes financial sense. Next week, I'm covering the Medicare trap that hits surviving spouses. Your premiums can double overnight, and most people find out when it's too late. Hit subscribe so you don't miss it. Drop a comment below. What state are you in, and do they tax your Social Security? I read every single one. I'm Joshua. This is Senior Benefits Decoded. I'll see you in the next one.